everybody. Thank you for that great introduction, Amanda. It's great here to be in Alberta, and I'm sorry that I missed all the fun. I see some of the pictures up there, and it looked like you had a lot of fun yesterday. So I don't think it's a big sell or an exaggeration in this crowd to say that we're in the midst of a defining moment for innovation in financial services. And some are saying that the new technology is going to cause a complete disruption of traditional financial institutions and give businesses and households access to more convenient and customized services. And entrepreneurs are also finding applications well beyond finance. And these new technologies could transform fields as diverse as humanitarian aid or even the diamond industry. So fintech, which is just a term that people seem to have cottoned on to refer to innovation in financial services, has created a lot of excitement, but also quite a lot of hype, depending on your perspective. And fintech has also attracted real money. At a global level, almost $20 billion was poured into fintech last year alone. Many of you in this room may be using Apple Pay or Google Wallet. You may be even getting investment advice from robo-advisors. There's peer-to-peer lending, and even more services are in the works. I've had some fascinating discussions with my colleagues at the Financial Stability Board and other international organizations, as well as with entrepreneurs and financial institutions just across the globe. And I can tell you that no one really knows what the social and economic payoff of all these investments will be, despite all the hype. And no one even really knows for sure what fintech developments will ultimately mean for business models or for the financial system. It's still early days, but I can tell you, we're all trying to figure it out. I know this interest extends to all of those in the payments business because it's undergoing its own transformation. And so I'd just like to take the opportunity to thank Jerry Gates and Paiements Canada for the invitation to speak here. It's a really good opportunity for you to hear a central bank's perspective on this. We've been doing a lot of work on fintech at the Bank of Canada, and so today what I thought I'd do is I would explore 3 points with you that frame our thinking on this range of territory. And the first point is that fintech has the potential to transform the financial system across a broad range of services. And that's a good thing because there is a lot of inefficiency that we can shed. The second point that I'm going to dig into is that although some of the technology may be revolutionary, its overall effect on the financial system is likely to be evolutionary. Financial institutions that adapt will survive. New service providers will become part of the financial ecosystem. In some areas, this evolution is happening pretty fast, while in others, like where there's the most transformative technologies, like distributed ledger, there's still some hurdles to clear. And my final point is that now is really the time for financial institutions, new entrants, and policymakers to work together. It's the best way to create the right environment for modernizing the financial sector and managing the risks. And this applies to many areas. For the bank, our focus is really on preserving financial stability and maintaining the safe and sound operation of core payment systems in Canada. And these 3 points that I've just made, I'm going to make them again in French for the benefit of the people on the webcast. So tout d'abord, les technologies financières ont le potentiel de transformer un large éventail de services au sein du système financier. Et c'est une bonne chose car il y a de grands manques d'efficacité que nous pouvons réduire. Ensuite, même si certaines technologies peuvent paraître révolutionnaires, leur effet global sur le système financier sera probablement évolutionnaire. Les institutions financières qui s'adaptent vont survivre. Les nouveaux fournisseurs de services viendront s'intégrer à l'écosystème financier. Et cette évolution pourrait peut-être se reproduire rapidement dans certains domaines, mais dans d'autres, ça va être plus lent. Et enfin, le temps est venu pour que les institutions financières, les nouveaux participants dans le système financier et les décideurs publics travaillent ensemble. C'est la meilleure façon de créer un environnement propice à la modernisation du système financier. So, let me just start with my first point, which is that change is definitely in the air. In many cases, financial innovations are simply interesting twists on existing technologies or existing business models. And they promise to lower costs and improve services and maybe even broaden access. Peer-to-peer lending is one example. And as we have seen in the taxi and hotel industries, new competition could fundamentally change the relationship that traditional financial institutions have with their customers. Now, the main issues for regulators in this kind of change seem to relate right now to consumer protection, market integrity, and rules against money laundering and terrorism financing. And authorities in Canada and around the world are working to close significant gaps in these areas and monitoring the implications for financial stability. But then we have financial services that are enabled by fundamentally new technology. And a prime example of this is distributed ledger technology. It has the potential to replace entire transaction systems or core payment systems, offer new products such as smart contracts. And so this strand of fintech could take us into uncharted territory. And regulators in this domain face issues related to governance, legal environments, and financial stability. Now, one might argue that the financial sector is always changing and that fintech is just a case of déjà vu. We've seen innovations in the past, like credit cards, ATMs, online banking, that didn't really revolutionize the financial landscape, even if they were huge improvements in convenience for customers. And financial institutions in these changes remained dominant players because they adapted. Often they adapted by buying emerging competitors, adopting the technology, and reducing access to legacy services. And right now, I see a combination of factors that point to the potential for greater change this time. And the first one is that customers are more demanding than in the past. Just think of the millennials. I have one at home who's 18. So they're looking for financial services that are cheaper, more convenient, better integrated with their online activities. And they expect these services to be personalized and faster, like all the things that they get on their smartphones. So in some way, it's not surprising that they expect instant access to their money. And that's one of the reasons we see a push to implement real-time payment systems in nearly all major jurisdictions. The second is that we're seeing large, well-funded non-financial institutions or non-financial companies such as Apple and Google starting to offer financial services. Now, a big advantage that traditional financial institutions have is the relationship and the trust they've built up with their customers. Tech giants also have a wide customer base and brand loyalty that could help drive innovation. Now, they're using their customers' information as well as their existing platforms to pick away at the most profitable business lines of financial institutions. And the final thing is that financial institutions and infrastructures have become relatively inefficient, while new technology at the same time has reduced barriers to entry. So some supporting systems, as you well know, are several decades old, and the door is just open to competition here. So this brings me to my second point, which is what kind of change can we expect from all this? Well, as I said earlier, traditional players will have to adapt to survive, and there'll be new players. And the new technologies that could be truly transformative have some way to go before they're ready for prime time. So I expect we're in for more of an evolution than a revolution. We're all talking about distributed ledgers, and so let me use that to illustrate my point. I mean, to some, I would have thought that ledgers would sound incredibly dull, yet innovations in this space have been game changers in the past. If you dig enough, you're going to find that the invention of double entry bookkeeping has been credited as one factor enabling capitalism. So it makes me wonder what people will say about distributed ledgers 100 years from now. So let's just first remind ourselves what this technology brings to the table. Well, the key benefit of distributed ledger technology, or DLT, is that you don't need a trusted third party to prevent double spending, and you don't need expensive processes to reconcile the information between ledgers. And the best known application of distributed ledger technology is Bitcoin. And the decentralized aspect of this application of the technology is why some predict that distributed ledgers could revolutionize entire industries. Some imagine a future in which state currencies have been replaced by decentralized digital currencies. I see this as highly unlikely. Few people have embraced digital currencies because they can't beat the competition in terms of store of value and medium of exchange. And national authorities will want to run their own monetary policy. The Bank of Canada is studying digital currencies because we issue money, and we need to know what these currencies could mean in some alternative future for monetary policy and financial stability. In fact, I agree with many who think that the potential for distributed ledgers is actually stronger for applications outside of digital currencies. We've seen test cases for payments and post-trade processes, including clearing and settlement of financial instruments. And we may also see applications in areas such as trade finance, where information is across jurisdictions and it's really difficult to centralize. One study, and there are lots out there, found that distributed ledgers could save banks as much as $20 billion a year in global back office costs if it were applied to cross-border payments, securities trading, and compliance. So it's easy to see why private enterprise is investing money in distributed ledger technology. If these ventures deliver on their promises, improvements could go well beyond efficiencies and cheaper processing. You can think of reducing counterparty risk. You could think about increased transparency. So faster settlement would reduce these kinds of risks, but especially these days, they could also free up capital in financial institutions for other uses. That being said, we really need to recognize that there are several issues with distributed ledgers that must be solved before we can reap the benefits. And the first one on the list is technical issue. Technical issues related to things like scalability and data privacy, and I'm sure that you've talked about these over the last couple of days. And the second one, which is really important, is that participants will have to agree on governance of the ledger. And this can be a challenge when stakeholders have divergent interests, and we saw how that played out with Bitcoin. And finally, it's going to need standard and protocols, as well as a solid legal foundation to be interoperable. And interoperability is maybe one of the biggest benefits of this kind of technology, potential benefits. And you need to remember, not too long ago, how important the first networking protocols were in the early days of the internet. And just to add to the list, distributed ledgers will have to be widely adopted. It's no small challenge to get users to move away from established networks and flock to a new network that's based on distributed ledger technology. And you just think about Facebook as a good example of this networking effect. People flock to the service that their friends use. The last hurdle that distributed ledgers face is to gain regulatory acceptance. Authorities should absolutely support innovation. Yet the bar will be high, especially for core financial services, and appropriately so, because Canadians depend on them. So there's a lot going on here. Financial institutions for their part, including Canadian banks, are working hard to test and adopt new technologies, and they're adjusting to new trends. And so while banks may look different in the future, they'll still play a major role in the financial system. It's true that some changes may seem revolutionary to some incumbents, but to customers, it will likely seem evolutionary, and some changes, especially those that occur in the back office, won't be visible at all. In some ways, DLT is reminiscent of voice over internet protocol. It was a revolutionary advancement in technology that caused an evolutionary change in how we use the phone system. But even today, a phone call is still a phone call. So this brings me to my final point, and it's that now is the time for the private sector and the public sector to work together. The opportunity cost of just sitting back and waiting for the dust to settle is just too great. Financial institutions and infrastructure operators are making important strategic decisions about which parts of their business they want to defend and grow, and which parts of their business they want to scale back. And this urgency, at least from a bank perspective, is not coming from fintech contenders alone. Banks are also dealing with a more demanding regulatory environment, and they're dealing with exceptionally low interest rates around the world that are squeezing profit margins. Banks already spend around $200 billion a year on IT globally, so replacing legacy systems will mean very critical investment decisions. For the Bank of Canada, our priority is to see upgrades made to the core payment systems we oversee. I'm talking about the large value transfer system and the automated clearing settlement system. These systems have served us well, but both require investments to fully meet our oversight requirements. Investments will also help the systems better meet the modern needs of participants and their customers. And I can just take ACSS as an example, which still handles most of the transactions today, the retail transactions today. It was implemented over 30 years ago when everybody wanted a Commodore 64. I know my parents bought one. So the ACSS might have been at the forefront then, but it certainly isn't now. Checks take 4 days to clear, and some information needs to be re-entered manually. So now is the time to make our core payment systems more efficient and competitive. For customers, consumers, and business users, we need to move closer to real-time access to funds. In both ACSS and LVTS, we need to collect richer data on transactions. And ideally, we would make them interoperable to avoid having to manually re-enter information. This effort is not change for change's sake. If we can leverage some of the existing infrastructure and still achieve our goals, well, all the better. For our part, regulators need to address innovation in a few proactive ways. And the first, in my mind, is to develop a solid analytical framework that we can use to assess the benefits and challenges of something that's so new. And this is something that the Financial Stability Board is working on along with others. Authorities are going to make their assessments through many lenses, like consumer protection, financial inclusion, market integrity, competition policy, and financial stability. And that's why other international groups are involved as well, like the Committee on Payments and Market Infrastructure and IOSCO, the Basel Committee. And the Bank of Canada, together with our domestic colleagues, is actively contributing to these efforts. FinTech is a global phenomenon, and so it's critical that the regulatory effort is global as well. While FinTech may solve some problems, they may also create new ones. And there's a lot of things that people have talked about, and I'm just going to give you one example that's on my mind, and that's the network effects that I worry about, network effects are what underpin the success of many payments applications. Well, these network effects could lead to an excessive concentration of risk of payment service providers. If this happens, households and businesses may not benefit from cost savings. This is clearly an issue for competition authorities. but it's also an issue for financial stability because too big to fail could emerge in a new form outside the current regulatory perimeter. And we all know how terrible too big to fail can end up. So once again here, I can use payments as an example. Unregulated players could become important to the system even if they never take on bank-like risks, like maturity transformation or leverage, or even if they never become big enough to be considered systemically important. Now, the move to direct access is important, but it also means even smaller players could very well create critical dependencies in the financial system, particularly if they connect directly to core payments infrastructure. This could give rise to moral hazard and other risks. So, at a minimum, authorities need to put a large enough weight on operational dependencies when looking at systemic importance, particularly in light of cyber risk. When a payment system in Canada grows to be prominent or systemically important, the Bank of Canada's job is to oversee it. But even before we reach that point, regulatory measures should be considered to address specific issues such as operational resilience and consumer protection. I'm also wondering how infrastructures that are based on distributed ledger technology could affect the financial ecosystem. And here I'm thinking about ever-increasing automation through, say, smart contracts. They could improve efficiency and certainty of execution, but they could also increase financial volatility. Would this volatility entail pro-cyclical dynamics or new challenges of channels of contagion? Well, it's something that we'd have to look at. So there are also questions about whether the regulatory perimeter is adequate given risks of regulatory arbitrage. In my view, we should be considering the inherent risk and systemic importance of the activity, regardless of what entity is performing the activity. We should seek a regulatory response that is proportionate to the risk. And at the same time, we can't forget the importance of a level playing field. Some of these issues are very interesting, but they're also very similar to the issues that authorities face in the area of shadow banking, where entrants are challenging traditional players. So the second way for authorities to address innovation in financial services is engagement with the private sector. Some countries, like the UK and Singapore, have created official regulatory sandboxes. That's what they call them. The Bank of Canada is partnering with Paiements Canada, Canadian banks, and R3 to test distributed ledgers. And our only goal at this stage is to understand the mechanics, the limits, and the possibilities of this technology. Now, the plan is quite interesting. It's to build a rudimentary wholesale payment system to run experiments in a lab environment. Now, as part of this experiment, it includes a simulated settlement asset that's used as a medium of exchange within the system, and they called it CADcoin. It's very much like the settlement balances that we already have in LVTS, which is our large value transfer system, except for it's using distributed ledger technology. Now, because this settlement asset can't be used anywhere else outside the system, it's a different animal altogether from a digital version of our currency for widespread use. Now, this is an experiment in the true sense of the word, and I can't think of any better way to understand how this technology actually works than to roll up our sleeves and build something with the private sector. Now, other frameworks for this are going to need to be investigated, and there are many hurdles that need to be cleared before such a system could ever be ready for prime time. Well, the third way to address innovation is fundamental research, and we shouldn't lose sight of that. Banks' research in this area in the past few years has focused on new payments methods, the adoption and competitiveness of digital currencies, and the conceptual merits of a central bank issued e-money. We're broadening our work now to include other developments like peer-to-peer lending and uses of distributed ledger technology. But we also want to understand how new financial technologies will address the underlying forces that created the need for financial intermediation in the first place. In theory, new technology could enable a different framework for addressing the same frictions, potentially one that does not require financial intermediaries at all. Well, in practice, I don't see it turning out that way. The names and faces may change, but I don't see technology changing the need for maturity transformation, loan monitoring, credit intermediation, and most importantly, trust. It's a good question for academics. So it's time to wrap up. While we have to filter out the hype around fintech, I'm convinced that it could have a net positive impact on the financial system if the risks are managed well. Fintech will likely entail more of an evolution than a revolution. And that's because financial institutions will adapt, new players will join the financial ecosystem, and the strong business models will survive. And the most transformative technology so far, distributed ledger technology, has still important hurdles to clear. Innovations may solve current problems, but they could also create new problems. The regulatory framework needs to adapt so the door is not open to unmanaged financial and operational risks, unchecked critical dependencies within our financial system, and moral hazard. Promoting financial stability is a core function of the Bank of Canada, and we take a system-wide approach when we monitor risks. There's a lot of hard work ahead, and we need to get on with it. By working together, we can unlock the full promise of fintech and ensure that a smooth evolution to the financial system of tomorrow that's safe, sound, and serving the people who rely on it. Thank you.
So the governor has agreed to take your questions, I think, from the room, although I don't see microphones, but I'm sure that we will be able to hear them, and I'll repeat them. How far off are we from a central bank-issued digital currency?
I think we're very far off. It's in the minds of researchers right now looking at the conceptual issues related to it, and I can tell you that there are a lot of conceptual issues to work out, including why we would actually want to do that or need to do it as opposed to the private sector, and also how it might change the dynamics in the economy, including how banks fund themselves.
One of the visions for distributed ledger technology, and it's the one that the kind of Bitcoin advocates adhere to, it's not a private ledger like the one that you're testing. It's a public distributed ledger.
Sure.
And it bypasses central banks, state governments, state currencies. Where are you at the FSB and at the bank in thinking about the policy implications of that, if it should go anywhere?
Sure. It's important to, I've always said that it's important to look at alternative futures where you could have a radically different financial environment, a radically different financial ecosystem. And when you look at that kind of financial ecosystem, you very quickly realize that you can't disintermediate everybody. Because at the end of the day, countries will want to, or jurisdictions will want to implement their own monetary policy. For that, they need their own currency. You'll need a lender of last resort, and there's no better lender of last resort than a central bank. And there are just many other reasons like that where total disintermediation just doesn't make sense.
You mentioned the unregulated players. Who's on that list for you? Who are you all watching? And I know that's a global question, not a simply Canadian one.
For sure. Well, in Canada, we just looked at the payment systems that we would be able to oversee given our mandate. And we just designated ACSS, which is the retail system that I was talking about. We monitor all the players in that space on a yearly basis to see whether they would come under our umbrella. The federal government last year, you may have noticed, was looking at oversight of the payment system and more generally, so smaller players. And they're just thinking about that right now. So I think for Canada, it's just too early to say who those other players might be.
And globally, is there kind of a working list of the folks that might need to be regulated at some point?
There isn't a working list. I think what there is a working list of kinds of risks that we need to make sure are properly managed. And that's one of the reasons. There's always financial risks, maturity transformation, leverage, liquidity. We talk about that a lot, and that's very important. When it comes to some kind of financial services, particularly core payments, then legal risks, governance, and operational risks are very important. Just take an example of cyber risk. If you've got somebody connecting directly into you, you're only as strong as your weakest link.
As a regulator, and we heard this from payments folks from other jurisdictions, including Australia, you can actually shape the direction that the payment system goes quite forcefully, I think. What role do you see, because as you say, there's excitement and there's hype around fintech. Yeah. What's the balancing act of making sure that it's stable and trusted and all of the things that you're here to do, but also letting the innovation flourish? Because the taxi regulator would not have allowed Uber to be.
What it is, to be quite honest, is a very fine line between having the private sector do what they do best, which is innovate and decide what are good projects that are going to have a payoff for them, an economic payoff for them, and then making sure that that is safe and that it's going to serve the financial system and consumers and businesses well. And for me, there's a couple of ways to do that, and one of them is just to work with the private sector so you actually understand the nature of the risks. Because often if regulators don't understand it, they can come up with inappropriate or stifling regulation. I think the second thing is to help in the development phase so that, and contribute at the development phase so that the developers actually understand what the rules of the game actually might be. And in doing that, that actually could help innovation because they'll get their business and their models right, and they'll get their technology right because of that.
So you have this private sector partnership that you're undertaking right now on distributed ledger technology. When do you expect to sort of have a sense of what you're learning and what you're going to do with that information?
It's really early days in this project, and it's an interesting project. What they've done is they've defined it, they're starting to work on it. Because this is a real lab experiment, there's no specific timelines for when we're going to learn things.
In your view, is that something that you're going to have to be regulating and concerning yourself with in an increasing way, this sort of technology?
I think that, as I said in my speech, I think that distributed ledger technology actually being implemented in something as core as the core payment system is a long way off. There are just a lot of hurdles. So the next generation of payments that the Paiements Canada is working on is likely going to be based on another technology.
All right. We're going to leave it there. Please join me in thanking Senior
That's
Deputy
great.
Governor
Thank
Carolyn
you.
Wilkins.
Thank you.